Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, July 12th, and then we'll see how things look for Thursday, July 13th. The CPI came out, and the market reacted very positively to that. We shot up higher, we kind of fizzled out, saw a little bit of weakness, didn't see as much of an up day as maybe we would have thought we would have seen, but still it was an up day. Unfortunately, we're starting to become extreme positive. You could suggest that we're overbought. But overbought in a bull market is a little bit different than overbought when we're going down. We really pay attention to the overbought and oversold indicators when we're chopping down lower. Well, we can let them ride a little bit longer sometimes when we're in an overall up market, and that's what's happening. We saw some strength in the S&P. We saw some strength in the NASDAQ 100. We did not see much strength in the transport, so that's a little bit of a concern. But overall, we're switching back to a much more positive stance. We still have some overhead resistance to deal with, and we'll see if the market is able to get through that. So what can we talk about? First, at the open, we had a gap higher open above R1 at 44.52. We also went above R2 at 44.66. We topped out at 44.88. As the day went on, we fell to R2 before climbing back above R2. Prices fell from higher levels to close off of the high. We were up 0.74%. We were up well over 1% when we were at the high. Volume, though, remains below average. And the technicals are positive, looking a little extended to the upside. That could be showing momentum at this point. And it's all about inflation and interest rates. What are some comments that we can make? The CPI was taken as positive. The S&P 500 and the NASDAQ hit new 52-week intraday highs, not closing highs, but intraday highs. The mega caps and the broad market showed strength, so there was more participation. On a short-term basis, our list is getting longer. We have our moving average study, the CCI 14 and 20, the Stochc RSI, the Williams percent R, the standard deviations chart, and the stochastics. These are our usual suspects when we start to move higher pretty quickly. Intermediate term, we have the balance of power. Haven't seen that in a while on this list. We're still looking at those negative divergences with our oscillators, the Sean trend meter, the bullish percent index, or BPI, both for the S&P and for the NASDAQ 100. On a long-term basis, we're keeping an eye on our moving average study, and I have all the charts to show you this. The dollar was down and interest rates were down, and both of those together gave support to stocks going higher. We still have our yield curves that remain inverted. Sentiment is still extreme positive at 80, where it ticked up from 79. Our trend is positive and advancing. The green line's going back up, but we're still barely below the moving average. We're trying to turn back up, but both the ADX and the moving average are above 20. I've switched our bias and momentum to being positive. Now, for those of you that are new, bias is usually one day. Did we have an up day or a down day? Not always. Sometimes I'll carry it over into a couple of days. Where momentum is the last 2, 3, 4, 5 days, kind of taking it together. This is the most subjective part of the video that I do, where I actually come up with what I think these are. I try to let everything else speak for itself. So, the economic reports that came out, the CPI, we had total CPI came in being up 0.2% month over month, less than the 0.3% they had expected. One thing that they're focusing on a little bit more right now is the index for shelter, and that accounts for 70% of the increase that we did see. It's costing more to live places. The core CPI, when you take out food and energy, it was up 0.2%, also less than the 0.3% they had expected. Year over year, the CPI is up 3%, where last time we were getting it at 4%. And then the core CPI was coming out at 4.8%, where last time it was coming out at 5.3%. We also had the mortgage applications index for the week. It came in up 0.9%, where last week it was down 4.4%. One thing that was interesting, and this came out in yesterday's Wall Street Journal, it was before the CPI was released, and I just had to kind of chuckle at this, looking at the headline, "Measure inflation differently and it's behind us." Well, okay, you could do that with pretty much anything. If you're into sports, if you measure only the games that your team won, you're undefeated. I mean, you can change things around, and that's part of what they do. There's a lot of manipulation that's going on. It says at the beginning, gauge U.S. price changes the way that Europe does, and inflation was already just below 3% in May. Again, this is before the CPI came out. Well, we did change the way we measure inflation, and that's why I show you the other charts that talk about what would inflation be if we calculated it the same way it was in 1980 and then in 1990. Unfortunately, those charts haven't been updated yet, so I can't get those to you until the next video. Here is the year-over-year change showing that the core and total inflation are declining. And then when you look at services and commodities, we're also seeing declines. And then here's the chart that I use. If you want to pause this, this gives more of a definition of what they're actually looking at in CPI. And I just got this from Investopedia, where when we're going back on a year-over-year basis, we're showing inflation decreasing, a little bit of an increase from one month over to the next. Then the core CPI also is showing more of a decrease and also a decrease on a month-over-month basis. Some Isabel Net blog charts. This is a historical chart. I'm not going to go through all of these things. This just measures what was the Fed funds rate doing at that time, what was the S&P doing at that time, and just gives you different things that happened. We're looking at the Bloomberg Dollar Spot Index. Spot means right now, what's it worth today, instead of futures that try to measure what will they be like into the future, hence the name. Then they have the Bloomberg Dollar Index and then the non-commercial future positions. Basically what all of this is saying is there's a lot of people in the dollar right now. We're seeing the spot index going up. We're seeing these bars also going up. And it's just suggesting that people are still pretty positive about the dollar, despite what you may be hearing about with the dollar really going down the drain and with digital currencies coming out to replace the dollar in the near future. Then short interest, and I try to give a little explanation every time we see this chart. These are the number of people who actually sell to get into the S&P and then have to buy to get out. We want a high level of short interest because if we really start going up, they have to buy to get out, and that's what we call a short cover rally. Well, here it's pretty low at 1.8%. Now, this may also be because there are other instruments that you can use. I go short in the S&P all the time, but I do it using mutual funds, so I'm getting in long to a position that benefits if the market goes down. There's also what we call inverse ETFs that you can also use. When an investor will just go right in and short the market itself, that's a lot more risky, and you have to have a lot higher requirements to do that financially. Then we're looking at the S&P 500 futures positioning, also showing a lot of strength right now. We're heavily long in those instruments. But when they ask, are you likely to increase or decrease your equity exposure? It's dropped down to 26%. We hit that little rough patch, sideways patch around the 4th of July or so, and people were getting a little bit more negative. When we look at the equity allocation, it's right now at 60% where it had been declining, and now it's starting to turn back up. This says the Fed tightening always breaks the labor market. This dark blue line is the Fed funds rate, and then we have the job openings, which are starting to decrease, and that's kind of what we're waiting for. That's what a lot of people who think we're going to go into a recession, they're just frustrated right now because we're not really seeing a decrease in the employment situation. Now, you can look at some different studies and show that there's a lot of layoffs and that they're really cutting back in different areas, and the quality of jobs might not be as good. But the market looks at this to really get its information, and as long as this remains strong, it's going to suggest that we're not necessarily heading into a recession, at least yet. Now, that could change. We look at the ISM PMI, and then we compare it with non-farm payrolls, where the non-farm payrolls are declining a little bit, but they're still strong. We were up 339,000 jobs, where the ISM PMI is dropped below 50 and is now at 46. So we're seeing a bit of a disconnect here. We also look at exposure to bonds. It's getting out of bonds a little bit. That seemed to be the place to be earlier, but the bond market's been running into some problems lately, and so we're seeing folks getting out of that. Then we look at the MBA US Purchase Index, where we saw a little bit of an increase, and now it's starting to go a little bit lower. That's the dark blue area here, and then we can compare that to what has happened in previous years. Getting into our charts and analysis, here's the intraday chart where we just shot up higher. We were above R1, R2. We came up here and then immediately hit the high at 44.88, fell back down, and R2 now acted as support. We were able to bounce up off of that, but then going into the close, we saw some selling. Almost got back down to R2, but then ended up finishing above R2. And when you look at the intraday chart, where the futures were pretty quiet, and then they started to show some improvement, right when the CPI came out, that's when we saw things shoot up. Here is the cash session. We're drifting a little bit higher than the initial overnight session. We do see still where value is outperforming growth. The red line is on top of the green line. But when you look at the closing values, they were pretty much even. Value to growth with the large caps, the mid caps, and the small caps. So they were more evenly split. And this is also a little bit of a concern. We were positive with our SPY growth to value ratio, but it didn't really spike up like the rest of the market did. Looking at sentiment, still suggesting there's not a lot of fear. When we look at the Ulcer Index, we went down with the VIX on the line chart as well as the bar chart. Volatility is picking up just a little bit. And we're still keeping an eye on this. We're above this dashed line. It continues to go up right now. When we'll really pay attention to this is after it spikes up and then starts to come back down. Maybe it's done that already, but we don't know that until it starts to actually decline. The equity put call ratio continues to decline with the up day. This is also looking more positive with our longer term moving average on the equity put call ratio. The VIX to move ratio ticked up a little bit, but shows that fear is pretty low. We look at the move index on top where bonds were up, so volatility went down. Stocks were up, so volatility measured by the VIX was down, and the correlation is pretty strong right now. We saw this other fear gauge that we look at decline, as well as the additional fear gauge that we look at. Folks are still favoring a risk-on posture. Our advanced decline line showing a nice little improvement based on price. We're also breaking out a little bit based on volume. Where it hadn't broken out yesterday, now it's starting to go up higher. We saw a really nice advance in the new highs. Not enough yet to really turn our 5 period up, but our 10 period is starting to turn back up positive. The advanced decline ratio above 0 and advancing. Accumulation distribution actually ticked down a little bit, but is still above the moving average. Seeing an improvement with our cumulative new highs, new lows for the NYSE. Also breaking out with our regular NYSE advanced decline line. Still above this trend line with the other NYSE advanced decline line. The common stock based on price is showing an improvement as well as volume. Looking at our advanced decline line studies, the NYSE, the S&P, the mid caps, and the small caps all had strong up days. Our trend, we're trying to turn back up with the ADX above the moving average, but we haven't quite done that yet. The green line is on top and advancing, but be kind of concerned here. We're coming back up into this 40 area. Doesn't mean we have to stop here, but in the past, this is generally signaled up too far, too fast type of reading. Our short-term ADX is also getting back up into this 40 area, trying to turn back up above the moving average. So with both of these charts, we still default to the positive. Volume, though, even though it ticked up a little bit, is still declining overall. Our short-term charts, we're breaking out above these previous highs right now. Now, this bar isn't all that good looking, where we set the high right after the open, and then we spent the rest of the day coming down. So that's not necessarily positive just when you look at the bar itself. At the bottom, you can see where volume did pick up, but is still below average. We did get above our double and triple exponential moving averages based on 20 periods. And we're starting to get extreme with our 20, getting extreme with the 50, and showing improvement with the 200-day exponential moving average study. The Stochc RSI, not very far, but we're getting a little bit into extreme positive territory. Just a couple days ago, we were extreme negative. The Williams percent R also getting extreme positive. The CCI 14 and the CCI 20 are also extreme positive. The stochastics getting extreme in the short term, showing improvement in the intermediate term, still rolling over a little bit, but extreme positive in the long term. The force index was able to get back above its midpoint and is above 0, so that's positive. Our intermediate term charts, the balance of power, starting to look a little extreme. We're above the 50 period moving averages when we look at our double and triple exponential moving averages. The go-no-go system is switched back to the darker blue bar. That's positive. We're kind of chopping sideways and starting to break out a little bit with our highest high value on this chart. We need to see follow through for this line to turn and start to go back higher. The TTM squeeze, it's still declining, but it's turning back to a darker shade of blue, which is more positive. We're getting up into the third standard deviation now with our standard deviations chart. We're going back above the zero line with our 14-period ease of movement. The Arun indicator saw an increase of buyers, but also an increase in sellers, but our oscillator is turning back up. Not so long ago, it was giving us an extreme positive reading. Our longer-term PPO still looks positive. The McClellan oscillator for the S&P is above zero and advancing. That's positive. So our summation index based on price is showing improvement, and we're turning back up now based on volume. The NYSE McClellan oscillator above zero and advancing, so the NYSE summation index based on price and volume are advancing. The Elder Impulse system for the S&P is positive with a green bar. We're also positive with the parabolic SAR. The slope is trying to turn up a little bit, but is still negative. The MACD is also turning up a little, but is still negative. We're still seeing some negative divergences with all of our different oscillators, and I've explained two possible reasons for that. One is that we're getting exhausted, and the other one is you mathematically calculate these indicators, and so it can't help but diverge. The Sean trend meter starting to get extreme positive. The PMO trying to turn back up. We've gone higher based on price, turning back up slightly based on volume. The PMO study is showing where the percent of PMOs that are rising tick down just slightly, showing an improvement with the buy signals as well as the PMOs that are above zero. The BPI starting to get extreme positive, but also suggesting good momentum. The NYSE BPI is also showing improvement. The Chaikin money flow continues to be positive. The Chaikin oscillator ticked down just a little bit, but is still positive. The money flow above 50 and advancing, that's positive. The vortex, the green line, is starting to go back up. That is positive. Ultimate oscillator ticked down just slightly, but is still above 50. The RSI, still seeing a negative divergence here, but we turned up with the 14 and the 9-period RSI. On balance volume, above an advancing moving average. Showing improvement with our 200-period study for the S&P 500 and our 50-period study. Also seeing some improvement on this chart, which shows the same thing. I don't have any Fibonacci or line studies now because we're in no man's land until we figure out a good high or low to draw some more Fibonacci lines, and we're above all the lines that we have been watching. Our different charts, the Heikin Ashi is looking more positive, the Kegi is pointing up and is positive, the Renko is positive, and the 3-line break is positive. We did see some strength in the equal weight index, but we're still underperforming the S&P. When we look at the ratio between the S&P and the equal weight, it's declining because we saw more broad participation. And then another thing I was watching were the transports, where they actually ticked down a little bit. They didn't participate in the initial big up move that we saw. We also saw a little bit of a pickup with the utilities. When we look at the ratio between the transports and the S&P, it actually ticked down a little bit. But the transports are still starting to come up and perform about the same as the Dow. Looking at our discretionary and staples equal weight study, where we saw discretionary going higher, staples ticked up just a little bit, but we're really breaking out with the ratio. And this is another variation of growth versus value. The Dow is still above the pivot point, still above its moving averages. It was only up 0.25%, so it didn't really participate. The diamonds remain positive. And the NASDAQ, we're still just about at the 61.8% retracement level. Yeah, if you look at it based on the number that I have here, we have closed above that, but we want to see a real convincing move above that. Please be aware that these Fibonacci lines on here, I draw them myself, so they may not be perfect. It would be nice if a computer could automatically do that, but I have to just eyeball this. The NASDAQ also starting to break out above this previous resistance. So this is looking more positive. The NASDAQ is still showing where the cumulative new highs, new lows are declining, but we ticked up slightly because the raw score for the new highs minus the new lows was positive. The NASDAQ 100, we're also just barely starting to creep out above this previous high. Can it continue? The Qs for the Elder Impulse system remain positive. And here we're above the 61.8% retracement level for the NASDAQ 100. The NASDAQ BPI starting to get extreme positive again. And this is a new chart, kind of a variation of some other charts that we look at. The QQQs are on the top. That's for the NASDAQ 100. And the TLT is the long-term bond ETF. And then I measure the correlation between the two. They have a tendency to go in the same general direction. Well, we've been seeing them diverge, and now we're starting to see, are they going to come back more in line with each other? Because the spread between the two is pretty strong. The small cap index had a good day, but again, this is not a real healthy looking bar. To open up, go up, and then come back down and basically close about at the same place where you opened. We are above this resistance with the Russell 2000. The RSI is going up and starting to get extreme, and the MACD is starting to turn more positive. The small caps did outperform the S&P 500, but overall they continue to underperform. The Elder Impulse system for the small caps continues to be positive, and small cap growth did slightly outperform small cap value, and they remain in an overall uptrend. The mid caps also came almost up to this R1 level, and this also is not a real healthy looking bar right here. Then the mid caps for the Elder Impulse system remain positive. Mid cap growth actually declined when we compare it to mid cap value, but we're still in an overall uptrend. The home builders really broke out and are performing well. The S&P also went higher. The ratio between the two is going up, and the relationship between the two is also very strong. Keeping an eye on the financial sector, still above the 50 and 200 period moving averages. The financials also are starting to cross above this 50 period moving average. Went down just a little bit, but on a longer term basis continue to underperform the S&P. We ticked up a little bit with the regional banking ETF compared to the financial sector, but we're still in a decline. Bonds, after really spiking up with yields, have now fallen back down. And on price, where we fell down based on price, we're coming back up and we're able to close slightly above the 200-day moving average. This is the other area that we've been watching, where we saw a recent golden cross with the ratio suggesting there's uncertainty about interest rates. Well, the last 2 days, this has declined, but not enough to really shift it back to going lower. We're also keeping an eye on the 2007 level set for the 3-month yield. We're still above that level. When we really pay attention to this is when we start to come back down, and we'll see if that's giving us some kind of a warning. Our long-term charts, the Special K daily chart is positive. We're starting to get extreme with our 150, and we're already getting extreme with our 200 period simple moving average. We're also dealing with this resistance. We did not close above this line on the S&P weekly chart. We're also dealing with this resistance with the NASDAQ 100 weekly chart. We did not close above that. The NASDAQ to Dow ratio also up at this higher level now. We have not really broken out above this. We're waiting to see if these charts start to turn and go down and then tell us something. An update of some of our possible positive scenarios. The Qs ticked up against the S&P. A little bit of an improvement with discretionary to S&P, but large cap growth went down when compared to large cap value. We're also seeing the growth to value ratios, a little bit of an increase with the large caps, tick down slightly with the mid caps, and are pretty much flat with the small caps. The S&P to utilities ratio ticked down just slightly, but continues to go up overall. That often gives good support to the S&P. We're still above zero when we look at our 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. We're still up here in this extreme positive reading for the 10-day average of the highs and lows for the S&P. We're positive overall when we compare growth to value, but we are continuing to decline. That's a concern. Our 50-period exponential moving average of the new highs, new lows continues to advance, and our indicators starting to go up even higher. The Staples S&P 500 ratio continues to fall, and that's where we get some support from for the S&P. So our outlook. Technicals are positive, but we are becoming overbought. It depends on how we view this. Is this just suggesting good momentum, or are we going up too far too fast and due for a pullback? The economic report's coming out. We'll get the weekly jobless claims, the PPI, that'll be the big one, and then the Treasury budget, which comes out later in the day, and it's not really influential. The geopolitical events that we're keeping an eye on, but it's still about inflation and interest rates for the markets. Here's the updated version of the economic calendar. Here's the updated calendar for Fed Speak. There will be a speech on Thursday, but it's going to be well after the market closes. Here's the Stock Traders Almanac statistics for July 13th, where we are positive across the board. We will be on the 8th trading day of the month, which tends to be positive overall during a pre-election year. We're also coming up now into the middle part of July, suggesting that if the Nasdaq's going to top out, historically, this is when it tops out, and then we start to see some weakness. So our scenarios, not going with the down one right now because the technicals are positive, yet they're starting to become overbought, and we're still trying to figure out if they could even become more overbought. We're going with the positive one for right now, but be aware, we're starting to get extended to the upside. We're not going with the sideways trend because the ADX is getting stronger, although it's below its moving average. But both of them are above 20. The green line is on top and advancing, so we default to positive. The warning signs, our longer-term trend signals may be signaling a top. Those are those weekly charts for the S&P and the NASDAQ 100. We have not broke through those levels yet. Our oscillators are still diverging negatively. The VIX is still showing that there's not a lot of fear. The cumulative new highs and new lows continue to show weakness for the NASDAQ. The 3-month yield is still above where it was at back in 2007. Growth is in an uptrend, but showing some weakness for the S&P. And then we're starting to come into earnings season. Positive signs. We still have seasonality and setups that remain in the background. Our daily special K chart is positive, but be aware our weekly chart continues to be negative. Our longer-term equity put-call ratio is positive. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture. The transports are showing some improvement, but it was a little bit surprising that they didn't really participate in Wednesday's move. Lower price levels, if we start to fall, so far have been providing support. If we do start to go down, we'll be watching those levels to see if they continue to hold. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they are breaking out above those levels, but we need to see a continuation of that. The Staples to S&P 500 ratio is declining. The small caps just generated a recent golden cross, as has the mid caps, but also be aware that the S&P small cap index has not generated a golden cross. And small and mid cap growth continues to be positive. Our conclusion, the S&P is positive, but we could be getting to a point where we're becoming overbought. In the short term, we're positive, yet we're pretty much already overbought, but still, we could go higher with our indicators. Intermediate term, we're positive, but slightly becoming more overbought. In the long term, we continue to be positive. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.